You're listening to the Forex Training Group podcast, where we empower traders with knowledge. Our goal is to provide you with actionable tips and strategies that you can start using right away to improve your trading results. Make sure to sign up to get access to the most valuable free Forex training series around by going to forextraininggroup.com. Now, let's get to today's episode.
This is the audio version of the blog post entitled, How to Use Currency Correlation in Forex Trading, originally posted on the Forex Training Group blog. My name is Richard Davies, and I am the narrator for the audio version of this blog post. Correlation in finance is the statistical measure of how two different assets move in relation to each other. A positive correlation exists between assets that tend to move in the same direction. For example, a positive correlation is observed between the value of the Canadian dollar relative to the US dollar and the price of crude oil expressed in US dollars. Conversely, a negative correlation exists between assets that typically move in opposite direction. Such a negative correlation usually exists between the EUR/USD exchange rate and the USD/CHF exchange rate, for example. Currency correlations strongly influence the overall volatility of, and hence the risk involved, in holding a portfolio of Forex currency pairs. As a result, learning how to use currency correlation is a key element of currency risk management for any serious Forex trader to understand. To grasp the concept of Forex correlation in currency pairs, the trader should first understand how market correlation affects the value of currencies. Because of the fact that Canada is a major oil producer, its currency can be directly affected by fluctuations in the price of crude oil. If the price of crude oil appreciates, the increase in the price of the commodity will generally make the value of the Canadian dollar rise against other currencies. The Canadian dollar's relative value is therefore positively correlated to the price of crude oil. Conversely, the US dollar tends to be negatively correlated to the price of oil due to the fact that the United States is a net consumer of oil on the world market. Due to the market correlation of the individual currencies to the price of crude oil, an upward spike in the oil price would tend to negatively affect the US dollar to Canadian dollar currency pair. Currency pairs correlation arises out of the interdependence seen between currencies due to their being priced relative to one another and traded in pairs. For example, the euro-pound currency pair is a derivative of both the euro to US dollar and pound to US dollar exchange rates. Therefore, a trader that happens to take a long position in euro dollar and a short position in pound dollar has essentially taken a long position in euro pound, due to their long and short US dollar positions, which effectively cancel each other out. Furthermore, the euro-pound exchange rate is correlated to the exchange rate of both component pairs versus the US dollar, being positively correlated to euro dollar and negatively correlated to pound dollar. Forex pairs correlation. More about positive and negative correlation. Forex currency pairs are made up of two national currencies, which are valued in relation to one another. A number of different elements directly affect the value between two nations' currencies, such as the interest rate differential, the balance of trade between both countries, and whether the country is a commodity producer or consumer, to name just a few. Currency correlation occurs when the exchange rate levels of two or more currency pairs often move in a consistent direction relative to one another. This can be a position correlation when the price or exchange rate level tends to move in the same direction, or a negative correlation which occurs when the exchange rate level tends to move in the opposite direction. Furthermore, a lack of correlation would occur if the currency pairs typically move independently in completely random directions over a certain period of time. Positive correlation. When two currency pairs move in the same direction, so if one pair moves up, then so does the other. For example, the correlation of euro dollar and pound dollar is positive because if the demand for the US dollar increases, the level of both currency pairs will usually decline. Conversely, if the demand for US dollars falls, then the level of both currency pairs will tend to increase. Negative correlation. Negative correlation is the opposite of positive correlation, with the exchange levels of currency pairs usually moving inversely to each other. For example, a negative correlation exists between the euro dollar and dollar yen currency pairs. When demand for US dollars increases, the currency pairs often move in opposite directions, with dollar yen generally increasing due to the US dollar being the base currency in the pair, and with euro dollar declining since the US dollar is the counter currency in that pair. Because of the dynamic nature of world economics, changes in Forex correlated pairs do occur and make the calculation of correlation between currency pairs very important to the management of risk in Forex trading when positions in multiple currency pairs are involved. Changes in correlation can occur daily in some Forex pairs, which can in turn affect the accuracy of a trader's projections of long-term correlations. Some of the reasons for variations in correlations include changes in each nation's central bank monetary policies, sensitivity to crude oil, or other commodity price fluctuations and political and economic factors. Importance of the calculating correlation in Forex trading. Due to the fact that all Forex trading involves pairs of currencies, there can be a significant risk factor in a Forex portfolio in the absence of proper correlation management. Essentially, any Forex trader taking positions in more than one currency pair is effectively taking part in correlation trading, whether they know it or not. As an example of how correlation can increase the risk in trading two currency pairs, consider the situation where a trader has a 2% of account balance per trade risk parameter in their trading plan. If the trader takes a long position in euro dollar and another long position in pound dollar of the same US dollar amount, it would appear that they have assumed two positions with 2% risk for each. Nevertheless, the two currency pairs are strongly positively correlated in practice. So if the euro weakens versus the US dollar, the pound sterling also tends to weaken versus the US dollar as well. Hence, the overall risk assumed by the trader would be the rough equivalent of 4% risk taken in either pound dollar or euro dollar. Conversely, if the trader assumes a short position in euro dollar and a long position in pound dollar, the risks inherent in each trade will tend to cancel out to a certain degree due to the positive correlation of the two currency pairs. Opening opposite positions in currency pairs that are strongly positively correlated can be something of an imperfect hedge, since the overall risk of the portfolio is reduced. Calculating correlation in Forex currency pairs. Correlations between currency pairs are inexact and depend on the ever-changing fundamentals underlying each nation's economy, central bank monetary policy, and political and social conditions. Currency correlations can strengthen, weaken, or in some cases break down almost entirely into randomness. In the financial world, correlations are typically quantified and displayed in a Forex correlation table using a scale that varies from +1 to -1, where 0 is equal to no correlation, hence two currency pairs having zero correlation implies that the two pairs will behave in a completely random and independent manner from each other. +1 is equal to a fully positive correlation and implies that the two currency pairs will generally move in the same direction 100% of the time. And -1 is equal to a negative correlation, which means that the two currency pairs will generally move in opposite directions 100% of the time. In between these extremes, we can categorize correlations as per the following. Plus or minus 0.0 to 0.2 is a very weak correlation. Movements are essentially random. Plus minus 0.2 to 0.4 is a weak or low correlation of little significance. Plus or minus 0.4 to 0.7 is moderate correlation. Plus or minus 0.7 to 0.9 is a strong to high correlation. And plus or minus 0.9 to 1.0 is a very strong correlation. Movements are related to each other. Utilizing correlations in Forex trading. As mentioned previously, when trading more than one currency pair, a Forex trader is either knowingly or unknowingly involved in Forex correlation trading. One way of applying a Forex correlation strategy in your trading plan is by using correlations to diversify risk. Instead of taking a large position in just one currency pair, a trader can take two smaller positions in moderately correlated pairs, thereby somewhat reducing their overall risk and not putting all of their eggs into one basket. By the same token, the Forex trader could establish two positions in strongly correlated pairs to increase their risk while also increasing potential profits if the trade is successful. Using correlation in Forex trading also makes a trader more efficient, since they would tend to avoid holding positions, which might ultimately cancel each other out due to negative correlation unless they wanted to have a partial hedge. Risk managers overseeing Forex risks for large corporations with operations in many countries often use a Forex correlation chart to determine how to best hedge the company's foreign exchange exposure when applied to the company's different foreign operations. Such as a currency correlation chart can help to show a risk manager how to best offset their company's foreign exchange exposure by using forwards, futures, and option trades. Forex trading strategies involving correlation. Forex traders make use of a number of strategies using correlation. One such strategy involves two strongly correlated currency pairs, such as pound dollar and euro dollar. The strategy is used in a time frame of 15 minutes or more. The Forex trader waits for the correlated pairs to fall out of correlation near a major support or resistance level. Once the two pairs have fallen out of correlation, one pair will tend to follow the other after a significant reversal. Accordingly, a possible trading strategy would be to generate a buy signal if one of the two pairs fails to make a lower low, or a sell signal if one of the pairs makes a higher high. Other trading strategies might involve confirmation of reversals and continuation patterns using strongly correlated currency pairs. For example, if the US dollar is strengthening overall, euro dollar should begin to sell off. At that point, a decline seen in pound dollar would confirm the US dollar downtrend, with a decline in Aussie to US dollar further confirming the dollar down move. A variation of the above strategy might involve avoiding entering into a trade if two other strongly correlated currency pairs fail to confirm the reversal or continuation pattern observed in the target currency pair. Traders in the Forex market can also use correlation to diversify their portfolios. For example, instead of buying two pound dollar contracts, the trader could buy one pound dollar contract and one Aussie to dollar contract, since those pairs are both positively correlated, although imperfectly. The imperfect correlation allows for lower risk exposure and adds diversification to the trader's portfolio due to the Australian dollar being substituted for the pound sterling in one contract. Inherent risks using correlation in the Forex market. Since the 2008 financial crisis, correlation for major and minor currency pairs have been in a constant state of flux. Sociopolitical issues, as well as sudden changes in monetary policy taken by central banks in some countries, have altered or reversed traditional correlations for some currency pairs. In addition, the recent slide in oil and commodity prices has made previously weaker correlations significantly stronger in certain currency pairs involving the commodity currencies like Australian dollar, Canadian dollar, and New Zealand dollar. Another recent event that took the entire Forex market by surprise was the Swiss National Bank's move to end its self-imposed floor on the euro's exchange rate against the Swiss franc in January of 2015. The event significantly changed numerous correlations, albeit temporarily for some currency pairs. The Forex market is currently facing negative benchmark interest rates in Japan and the Eurozone, and a weak recovery in the United States as the Fed gradually raises interest rates. In addition, the market is dealing with a possible exit by Britain from the European Union and extreme volatility in the crude oil and commodities markets. While sudden changes in correlations can present significant risks when trading currencies, the sudden changes can also be used to a trader's advantage. Same direction positions in strongly correlated currency pairs can be used to compound profits in time entry and exit points, while opposite positions can be taken in strongly negatively correlated currency pairs to increase profits in the event of a major market move. Essentially, being aware of currency correlations can only make you a better trader, irrespective of whether you are a fundamental analyst or technical analyst. Understanding how the various currency pairs relate to each other and why some pairs move in tandem while others diverge significantly allows for a deeper understanding of the Forex trader's market exposure. Using currency pair correlation can also give Forex traders further insight into established portfolio management techniques such as diversifying, hedging, reducing risk, and doubling up on profitable trades. This concludes the audio version of the blog post entitled How to Use Currency Correlation in Forex Trading. Thank you for listening.
Thanks for tuning in to this episode of the Forex Training Group podcast. Make sure to head over to forextraininggroup.com to sign up for the free Forex training series filled with exclusive tips and strategies to take your trading to the next level. Be sure to subscribe to our podcast so you don't miss any future episodes. And please take a moment to write a review for our podcast in the App Store.